Good morning, everybody, and welcome to the IMAP Webinar series, Serving High Net Worth Clients, the Advice Profession's Most Valuable Clients. It's a two-part webinar series. Today, we're going to be talking about serving this market and the requirements of these clients, finding them and serving them. And then on Wednesday, we'll be talking a little more about the investment considerations for this market. I'm delighted to be joined today by Andrew Tracy from JB Weir and Will Howard from Fitzpatricks Private Wealth. But before I hand over to Andrew and Will to talk a little about their businesses, let me just put this in the context of a broader study which IMAP is doing. So high net worth market is becoming increasingly the focus of the way in which advice is conceived and delivered for the advice profession. And it seemed to us to be particularly appropriate that we try and look at it in a little more detail and address its requirements. And to that end, we've commissioned today's and Wednesday's webinars. As I say, on Wednesday, we'll be looking at the investment challenges in the high net worth space with Alex Ventelon from Morgan Stanley and Martin Crabb from Shaw and Partners. We're at the final stages of putting a white paper together to represent the results of the interviews that we've undertaken and the questionnaires that we've had a number of organisations complete for us to give us a broader sense of this market. And then as part of our Advice in Action conference series in July, in Melbourne and in Sydney, we'll then be taking some time for you to be able to attend in person and listen to and ask questions of a number of organisations who've really made this an absolutely fundamental part of their target markets. Those organisations will be Findex, JB Weir, Andrew joining us today, Shaw and Partners, Martin Crabb from Wednesdays, Climb, Fitzpatricks, and Will is with us today, and Jana. And we'll be talking about four really important topics that help us to focus on thinking about the high net worth market. Restructuring to address that market. What does an organisational structure look like if this is going to be a key part of your business's approach? Serving family offices, are high net worth investment clients, high net worth clients' investment needs different? And managing the compromise between high service and organisational efficiency. So we'll be taking those four topics as part of the masterclass. That masterclass is an adjunct to our Advice in Action conference. Melbourne, the 18th of July, Sydney, 20th, and Brisbane, the 25th. And then our additional conference in September, our next conference after that in September, as last year, will give us an opportunity to expose the thinking of a number of leading portfolio managers in managed accounts. So last year, 30 portfolio managers in Sydney and Melbourne gave us the benefits of their insights, and we'll be repeating that again in September this year. I'm sure I don't need to ask you to remind you how to ask a question, and I'd encourage you to do that, because the format of today's session is I'm going to invite Andrew and then Will to talk a little about their organisation and how they do address this market, what it means to them, the way they've structured to address it. But then we'll go into a discussion period, and I'd encourage you to fire through questions that reflect your thoughts about this market and the issues which it poses for you. Now, I should say before I go on that we're particularly lucky to have Will join us today, because Will is in fact in the UK it's 3 a.m. in the morning there. He's not there for the ashes. He's there because he's getting married in the next week or so. So, Will, thank you very much for taking the, going that extra mile to join us today. So without further ado, let me hand over to Andrew Tracy from JB Were to talk about how they serve high net worth clients. Thanks, Andrew.
Thanks, Toby. And what an understanding wife you've got there, Will, to have the honeymoon over watching the Ashes. I think that's an exceptional performance. Toby's asked me to speak a little bit about JB Were and a little bit about my background and also what we're doing a little bit in managed accounts, just to kick things off for the first sort of 5 or 10 minutes. A lot of you will know JB Were as a broking house that's been around for a very long time. I think we were set up back in 1840 as one of the founding members of the Melbourne Stock Exchange. So there's a lot of history and a lot of experience there with JB Were, and a very long-serving, what we like to refer to as an intergenerational client base. We've got some clients there at JB Were that have been with us for a particularly long period of time. I think we've got about 31% of our clients, if you look at the statistics, have been with us for over 10 years, and about 1/3 of our assets relate to clients who've got portfolios of larger than 20 mil. So the high net worth space, which is the topic for today, is very relevant for us at JB Were in terms of our back book. We've got average across our 150 odd advisors across Australia and New Zealand. We're managing about 64 billion in FUM FUA. Of that 64, we've got a very large presence of about $12 billion in the for-purpose area, the philanthropic services area, that's headed up by Sharmil Das, John McLeod, and that forms a very big portion of the attraction, I think, of the service we provide and our advisors provide out to clients, what we're doing with clients in that space, particularly around for-purpose with governance and setting up some of these organisations with the proper infrastructure before getting on to making comments about what stocks, what portfolio, what asset allocation, and that sort of thing. Mainly our advice comes from, obviously we've got an investment advice area. We've got some technical expertise that comes across from the structuring and financial part of the business, financial planning part of the business. I mentioned the philanthropic services. We've issued quite a number of industry papers on this. A lot of you would have seen some of those. The cause report, I believe, was the first one I recall seeing coming out of that team. The support report. There's also the giving index, the top 100, and you've probably seen a lot of that stuff coming out in the AFR from time to time. JB Were, we're 100% owned by NAB, and there's been a pretty volatile market we've seen post-COVID and through GFCs and the like, and it's good to have a strong bank balance sheet sitting behind you. We've also got some ties up with UBS from a research perspective and the corporate deal flow that we get from there and other counterparties that we have on the street. Lombard Odier is our Swiss counterparty. They've been around 200 years, so slightly longer than JB Were's time, but a very important partner for us to have from that offshore perspective. Moelis we use for some of our small cap research, and obviously we've got the connections into MSCI for a lot of our ESG governance research, also from the ethical filters and some of the rankings and ratings that MSCI provide into our research process. So that should give you a little bit of a background on JB Were. I don't think it'd be any surprise to most of the people on the call. My background, I started 39 years in the industry, I think is the number for me. 28 of that 39 years I've been at JB Were, and there's only 2 years of that period of time where the last 2 years, in fact, where I've switched across from being an advisor at JB Were, having run private client books, ran an intermediary desk in Sydney that covered a good chunk of the country, and the last 15 years of that, obviously, we've got the Institute of Managed Account Professionals. I've done a lot of work with IMAP over that period of time, and the last 15 years had been focusing in on specialising in managed accounts, and we've seen that fantastic hockey stick growth in the amount of FUM that we're seeing now in managed accounts. It's an overnight success. Just to give you a little bit of background on JB Were's involvement in managed accounts, we're one of the first to set up managed accounts internally. We set up an internal platform that had all the functionality and a managed account set up. We had probably close to and got to about $1 billion in FUM. We set it up in early 2000s. We didn't set up our external managed account business on external platforms until sort of 2008 through to 2010. And in that period of time, we've been growing the FUM externally. What we did internally was we got to about $1 billion in FUM internally, and we can talk about this a little bit further down the track in the question time, but we're a little bit slow in keeping up with technology and the changes. And as you saw, the provision of services and SMAs externally, we needed to do a complete replatforming of that business. So we've now gone through that process and looking to bring out managed accounts for our advisors and clients internally over the course of 2023. I might pause there, Toby, and pass that back to you. And if there's any other questions, we can get to those shortly.
Thanks very much, Andrew. And now it's my pleasure to invite Will to say a little about his business. Will is based in Newcastle, although, as I say, currently at an early hour of the morning in the UK, and to talk about how Fitzpatricks, a very different organisation than JBWE is, how they've approached this important market. Will, over to you.
Cheers. Thanks, Toby, and thanks, Andrew. A little bit of background. I joined Fitzpatricks Newcastle in 2009 after working with another wealth management firm for a couple of years in Newcastle. So I've spent the last 14 years with Fitzpatricks Newcastle, and nowadays I'm a senior advisor there. I look after around 65 pretty complex families. So when we think about those families, typically a third of those clients would still be in business, and the other 2/3 are generally retired business owners and professionals. Fitzpatricks is a little bit more, compared to JB, we are, I think, probably more focused on the broader advice piece. In addition, whilst we have an internal investment house being Atrium Investment Management, our typical ideal client is probably more an individual with a lot of financial complexity. And whilst we do act and have a wealth management function, our main value offering and engagement with the clients is more about being a lead advisor and being able to collaborate with a broad team of professionals, whether that be their accountant, their lawyer, their banker, insurance broker. So typically they're pretty time poor, and they're professionals that want one lead advisor to run a whole range of facets of their financial arrangements, in addition to the investment piece. So a little bit different in that capacity. Most of our officers in the group have a pretty similar ideal type of client. With the clients that are retired, typically their circumstances and their arrangements are a little bit more simple than those clients that are still in business. And that piece is a little bit more just around the capital management, the outsourced investment solution. Thinking about the investment piece and managed accounts. So Fitzpatricks have had initially started with a MDA license that would have been probably about 2005. And at various times we've used different outsourced parties, Dalton Nickel Reid for a period of time, before taking it internally and launching Atrium Investment Management in around 2011. So nowadays, Atrium run a whole handful of managed account portfolios for us. And one thing they specialise in, which is a little bit different in the marketplace, is risk-targeted solutions. So portfolios that are built largely around a risk mandate measured by standard deviation, as opposed to traditional asset allocation types of approaches. So that is one thing that Fitzpatricks certainly advocate, that is a little bit different in the market, whilst offering more traditional solutions. So the types of clients that we look after, typically, as far as the portfolios go, they're looking for something which is quite transparent, which is quite sophisticated and actively managed. But the clients are typically financial delegators too, so they don't want to be, or they don't seek to hear from us every month or so forth with investment ideas or talking about repositioning. Rather, they're pretty happy to outsource that and let us lead that. Obviously, again, with a high degree of transparency about what our investment team are doing and why at various times through the cycle. So that's probably a main summary about what we do, how we engage with our clients, what the typical type of client looks like, and the higher level of complexity, and I think probably the broader reach of our overall scope that we're across for our clients, in addition to the wealth management piece.
Great. Thanks very much, Will and Andrew. That was a great start. So let's, and I'd encourage you, if you're listening to this webinar, to fire in some questions. We've already had a number come through. So let's start off by talking about the expectations of clients, of their advisors. Andrew, Weas comes from a broking background and now part of a bank. Will, Fitzpatricks, as you said, more from a traditional financial planning background. How do the clients, what do the clients think of when they approach either of your organisations? What do you think their expectations of service are?
Well, I think it varies as widely as the clients do themselves from their individual risk profiles. All clients are going to come from a slightly different educational and financial literacy background. So it really comes down to the advisor and the client formulating that roadmap, if you like, for high net worth clients. I think when they come to someone like JB Weir, the ones that we see on the high net worth side, and I head up our discretionary business, which is a minimum of 20 mil, and we have advisors with discretion on that. We can talk about that a little bit later, but when we have clients that come into that space, whether they be high net worth, or we tend to classify them also as board directed entities. So, whether you be charities or foundations or the like, and those board directed entities quite often have very specific documented investment policy statements. So they are very particular about what they particularly want. It's documented, and the advisors have a very strict framework in which to operate that relationship in. There are requirements on us, and there are requirements on the client. So that part of it does get quite detailed and quite microscopic at times. They differ also in needs on reporting. Will mention some of the way they report. We use Barra, we use Bloomberg, but I'd have to say in looking at our systems, that is work in progress for us to be able to deliver what I would describe as a best-in-class reporting outcome for clients. I know our advisors have been seeking more detailed individual attribution reports. We can do it on managed accounts and individual large portfolios, but something that is more systemic is something that we are working on internally there. And I don't think there's a high net worth client these days that hasn't uttered the words ESG, RI, ethical investing.
I want to come back to that issue
it is
of ESG, because it is such an important one. And so Will, when you talk to a prospective client, I mean, what is it you're representing that Fitzpatricks will do? I mean, you're not brokers, you're not a bank.
Yeah, look, I think the best way to explain it, Toby, is clients seek to engage us to get control of their financial arrangements and help understand the complexity, help understand the interrelationship between the various entities, various generations within a family, business risk, as well as other asset protection risks across their balance sheets, but also to probably genuinely understand the client's context and what's important to them, their families, and effectively be able to collaborate with their broader professionals. Again, their time war, they want to delegate out their financial detail to professionals that can collaborate and come up with really, really great strategies and present them back to the client, whether that be around asset protection, structuring of their wealth, small business CGT concessions, the relationship between different entities, tax, acquisition of certain assets, or the development of a mandate, for instance, around it might be a private ancillary fund that they might have. So again, it's more about the broader financial affairs, really understand what's important to them and getting them financially well organised, and then keeping them financially organised. So if something was to happen to them, or one of their family members, that there is a really good plan in place, not just personally, but across all their various entities and their other professionals to know what needs to happen and when.
And how many of those services that you spoke about, estate planning, tax, wills and trusts and so on and so forth, how many of those services are provided by Fitzpatricks as opposed to either an existing service provider or somebody you invite into the relationship?
Yeah, look, so the answer is very few that are provided internally. So we have a best of breed team of professionals that we collaborate with, that we work very closely with, that handle similar characteristic clients. Sometimes the clients will come to us with their own professionals and we'll develop a relationship with them and collaborate with them. Some of the times they'll come and say, you know what, I know I haven't got the appropriate skill set in this area. I'd love for you to introduce to me to a couple of professionals that you know and trust and talk the same language to. So it is a separate team of professionals outside of the Fitzpatricks network. But the beauty of that is that also provides, and this is probably something we'll come back to shortly, a really strong centre of influence team to send back referrals and identify clients with similar characteristics that we can work with together.
And Andrew, how does WEARS is obviously part of the bank, so I mean you've got the banking side in spades, which I presume means the lending side primarily. How does WEARS handle these estate planning, trusts, the philanthropic side and so on and so forth? So.
Yeah, I think just on the bank side of things, I'll just make a quick comment there. I haven't been in broking for a long time, and I saw the broking experience with banks back in the 90s, and NAB and AC Good was the case in point. This is the first time I've seen banks and brokers actually get the business model right. Justin Griner did a lot of the work, our former executive at JB Weir, got that rolling, and Maria Lykuris, who's our current JB Weir executive, is continuing on with the good work that's been done there with the advisors, and our individual advisors all have relationships with NAB business bankers or a suite of NAB business bankers, and there are key performance indicators that each of those parties have on referrals of clients. And Macquarie is another one where Macquarie have a similar advice and banking relationship, and both of those businesses have got what I think that referral part right. So the bank is an asset. It's a referral source, and it's quite actively utilised, not by every advice team by any means, but those that wanted to have formed some really good relationships on that side. The one thing that differentiates JB Weir from a lot of our competitors, whilst we access UBS research for our core research capacity, we've got our markets and investments group internally, which is a team of about 35 professionals. And that includes Sally Auld, our Chief Investment Officer, Glenn Bertram is Head of Strategic Asset Allocation, Aidan Kerr is the Head of Equities, Andrew Hudson, International Equities. And we've got a whole suite of investment research on funds. We have our APL and our high conviction list. Gillian Gordon heads up the alts and RI piece. We've got a markets desk that does all of our street counterparty, whether they be derivatives, direct bonds to other counterparties, and the market area that I run, the discretionary middle office that runs the discretionary business we've got, and also the managed account piece. But our advisors would be using and leveraging a lot of that internal capacity, particularly the Sharmil Das and the John McLeod philanthropic services piece. And I know a number of times we've been involved in pitches where we haven't come with an investment proposal, we've come with a governance proposal. And I know that's unusual for brokers to do that, but it is you need to get the structure right, you need to get the governance right, you need to get the overlays right, the director education piece right. And to be honest, a lot of the directors I've come across in charities and for-purpose organisations are not necessarily completely aware of the legal responsibilities they have in that role. So, you know, a bit of toing and froing and getting those structures right and everybody on the same page, I think, is a big piece. Our advisors will work with existing lawyers, accountants, you name it. We'll work in with those, and if clients want that expertise, we're happy to provide that, but it wouldn't necessarily all be in-house.
So can we sort of touch then on the issue of how you do structure yourselves internally? Will, what's the sort of typical relationship management look like in Fitzpatricks, advisors, support staff, you know, the internal resources?
Yeah, sure. So Toby, in every meeting with a client, I'll be in there face to face, and I'll always have a second chair, an assistant advisor in there that is doing a lot of the advice work, the follow-up work, the communication, and the implementation from that. They'll also be doing communication with the client's other professionals that might follow on from those meetings around strategy work and so forth. And then obviously I'm responsible and I'm across the investment piece. Obviously, it's sitting behind that is atrium investment management most of the time, and a management account structure. And we're in regular communication with our investment team and pretty close to, you know, all the activities in the various asset class positioning, the outlook they have across the various asset classes and what they're doing.
And so do you have do you assign a team to a client, or the size of your office means that there's one team there and you've got a sort of set of relationships that you manage? Yes.
So within the office, every client has a specific advisor. So any client knows exactly, yeah, Will's responsible. A lot of those clients I've worked with for a very, very long time. And they know Reese is across my assistant, everything I'm in, and likewise anything around their arrangements, they can talk to him around. And it's, that's the structure internally within our office. And then obviously we collaborate with their professionals.
Yeah, and Andrew, how does it work in Wears? How do you, what is a sort of a relationship delivery structure look like for Wears?
I wouldn't say we're still servicing clients the same way we were back in 1840, but there's been a lot of technology and improvements that have come along the way. We've got 150 odd advice teams. Those teams can vary from, you know, 1 or 2 to you know, 7s and 8s. There's quite large teams in some of our office interstate. There'll be obviously financial planning, the technical expertise. You normally have someone who's an expert on direct equities, one on the unit trust, managed fund structure. And I think our advisors at JB Weir have got an average of about 22 years industry experience each, and the average advisor's been at JB Weir for 14 years or more. And we tend to have about 150 what we refer to as family groups. So the Toby Potter super fund, the personal account.
I won't qualify, Andrew, I can tell you that.
No, I'm just using it as an example, but we have those team approaches, and we do leverage a lot of that IP that comes out of the MIG markets and investments team I mentioned earlier, that 35, almost an in-house research team that takes everything that's coming into the market, whether it's coming out of NAB's currency units or the fast-moving consumer data that we get out of NAB when we get to look at the movements that we're seeing there. And some of that transparency is great to have for, particularly if you're an analyst on the industrial side doing retail stocks, or, you know, the Coles, the Woolies, the discretionary, non-discretionary retailers. That sort of integral data is quite important. Our guys are all still on commission on the grid as a team-based approach, and have been that way since I joined back in the mid-90s.
I want to come back to the sort of remuneration issue, but I just one thing I think, Will, you mentioned that you typically would have 35 or 40 relationships, family group relationships. Was that, did I get that number right for your advisors?
Probably a little bit more. Probably 60 to 80 would be typical. Families. So I consider, when I say a family, I mean a client. So probably 60 to 80, whereby advisors have got more of the family office, really complex strategic work. It's going to be the low end of that. just because of the broader range of complexity, week to week projects that those clients bring you on.
And that's,
complexity.
I mean, and
when it is more,
yeah,
when it is more investment management focused, there's a bit more scale you can build into it.
Right, and Andrew, you mentioned sort of 150 or so relationships for your advice.
That's the latest number I saw. We call them family groups, but they could be, an individual. They could be it could be the trust that they've put money away, the foundation they've set up, that sort of thing.
Yeah. And so what would the typical over a year? How many times would each of you expect to sort of engage with, a family group or a client group?
Proactive and reactive. The advisors are there and available for clients to pick up the phone. And JB Weir is mainly wholesale only at the front end. So we've got some retail clients in our back book, but at the front door, as new money coming in, we take the 2.5 mil wholesale definition as being the benchmark for new clients coming in. The question was asked online there, Toby. I don't know if you want to get to those. We can do it on the run if you like, but the question about the not-for-profit clients, do they need different services to individuals and high net worth? I think they need a different level of that. It can be the same service, but at a much more detailed or granular level, particularly when it comes to investment policy statements and governance documents that boards and NFPs operate under. High net worths, a little bit less so on that detail, but clearly you still need to have the risk profile and investment objectives and all those sorts of regular legal requirements that are required in that process.
Yes. Yep. And Will, how many sort of thinking about the sort of engagement that you would expect, your team to have with a particular client group through the course of a year?
Yeah, sure. So at a minimum, it'd be 3 to 4 times a year for my more simple clients. And then at the other end, the more complex family office style clients, it is monthly. There are monthly things coming up that you're responding to, meetings with their family foundation, tax planning meetings, asset protection meetings, asset acquisitions, a whole raft of things that happen throughout the year that you're there project managing a lot of the detail around.
That's so with sort of 60 to 8 client groups, that's a lot of work for the team to handle.
Yeah, I think probably the bit I would add, and I touched on this just before, probably the most scalable part of my client base and my business is those clients that the mandate is more around investment management, because with things like managed accounts and an outsourced investment solution like that, it is a lot more scalable. The family office style clients, they're always coming to you with different types of projects, complexities. Your fee and your engagement's charged to reflect that. However, you really do need the resources to be able to deliver that and be across the detail, the history, and being able to collaborate with the other professionals in the team.
That's a natural segue to one of the other questions that came through from the audience, which is, are those high net worth clients happy to go into managed account portfolios where they're effectively getting, in quotes, the same as everyone else, or is that not an issue for them? So good question. So, you both offer managed account services.
Yeah, on the managed account side, I think it comes down to horses for courses. Some clients will like to outsource the work of, do I buy BHP or Rio if there's a capital raising or a takeover or a rights issue? A lot of clients are not necessarily equipped or motivated to want to be answering that minutiae that's there. I think managed accounts can be suitable for every client. I think every advisor at JB Weir and across the marketplace, and you've only got to look at some of the investment trends data, Toby, that comes out on an annual basis. They do some fantastic work on not just managed accounts, but platforms and the like. And it's quite granular, that research, and it's been going for 12 or 13 years on managed accounts. There is some massive benefits for clients in terms of timely implementation and execution of changes to portfolios. if you go back to, let's go back to the most recent extreme market conditions, you could go back to GFC or beyond. But if you're just looking back to the COVID drawdown from the end of February 2020, and the following couple of months of market volatility, the number of changes that were made to portfolios. I know we went to 10% cash in our head fund, the JB Income portfolio, on the 28th of February, and then made a number of changes as we exited a number of stocks that were requiring as they do in these sort of markets, deeply discounted renounceable rights issues to recapitalize the balance sheet. Transurban was rumoured as one. The banks were rumoured as being another sector. I think Star City was another one that was starved of capital, that the market had really taken the knife to their share price. To try and cope in a market like that for the benefit of the end clients, the advisors do need some systems or some way of being able to do those sort of changes in a timely fashion. So I think it's yes, it's definitely for clients. Not every client will want that. Some of them will prefer to have the day-to-day conversation with the broker and keep that relationship there. I think that's perfectly reasonable, and most of our advisors would continue to have those relationships with the clients that want it. I think there is outside of the top end of an advisor's client book, I'd suggest, from our experience in running this externally with external AFSL holders, that I'd say somewhere between 40 and 60% of every advisor's book, and there's a lot of advisors on the call here, I'm sure, whether they be in financial planning land or broking, but I would say somewhere between 40 and 60% of your back book, your client book, should be looking at managed accounts, whether you impose that on them, whether you offer it to them, whether they ask you about it. They are solutions that will have a better outcome for the client. They'll have a better outcome for the advisor. IMAP tells us that an advisor going from direct equities to managed accounts will save 17.1 hours a week in time of paperwork trying to chase up clients, market changes, you name it. And we've done some statistics on our internal managed accounts, and there's significant time savings that we're picking up for advisors who leverage the technology, which is part and parcel of our industry, and we should accept and embrace it.
And so, Will, I mean, you've mentioned a couple of times the Atrium business that grew out of Fitzpatricks, and it's now a sort of standalone investment management arm of the group. How appropriate are managed? I mean, how much is that core to your investment offer for your client base?
Yeah, sure. So look, it is having an outsourced solution where, as an advisor, I'm not the investment analyst. I'm not the one picking between BHP and Rio Tinto, or calling the client and saying, I want to participate in a corporate action. That's not what our core value offering is. So we need a solution where we can outsource that to a team of professionals that can make those decisions along the way in a timely manner without having to engage the client. My clients will say, look, I want to give you guys the discretion to make these changes, use your skills and act appropriately when the opportunity presents. So a managed account solution is the perfect structure in which to do that. Most importantly for me, I want to be able to engage with my clients across the various broader strategies and keep them financially well organised. Again, part of that is the wealth management piece. But look, they certainly don't want to be having conversations at various times through the cycle about getting their approval to adjust asset allocations and bring things in and out of the portfolio. It's not what they're engaging us to do. They're saying, we trust you. Our matters are more complex and we want to engage you for you to be across all those broader things. And we trust your investment solution achieves those outcomes for us.
Well, that sort of leads to one of the other questions that came from the floor, from the floor then, which is sort of in the sort of order of priorities of clients to deal with either of you or either organisation. Where is investment performance within their sort of priority set? I mean, do they compare the performance of their portfolios with what they might see in the
they certainly do. So look, performance is important. given the typical characteristics of our clients and where they are in their life stages, typically they've worked pretty hard and amassed pretty significant sums of wealth that will be passed down through various generations and will have a big impact on those generations. So a lot of it is, they are monitoring us around our performance, but certainly also our ability to maintain capital in significant drawdown events. So equally important is not subjecting the capital to a 20% drawdown in a position like 2020 or prior drawdown. So it's as much in a capital preservation piece as it is the short-term benchmarking against various peers. So that certainly comes out in the long-term figures, but it's like capital preservation is equally important.
And Andrew, I mean, you come from a with the broking background. I mean, clients come expecting, I imagine, a bit more kind of aggression in their portfolios. Is that?
Well, look, I think there's no doubt a direct equity portfolio is the most efficient, tax-effective way to run an investment in Aussie equities or offshore, right? We all know that. It may not be the most efficient tool to use, but it has been the one that we've had for the vast majority of our JB Were existence. Look, clients always want performance. There's a risk profile and a set of parameters that they want to operate by, and then there's their expectations on investment performance. But that would be the bulk of a broker's conversation with clients on a regular catch-up. No client likes to have a fallen angel in the portfolio or a stock that's significantly underperforming, and they do take up a lot more time than is required for that one particular stock. But I don't think performance is the be-all and end-all. And in fact, we did a bit of survey data on, a number of 4,000 or 5,000 accounts that we have on our internal custody platform, and you compare it to, say, our strategic asset allocation performance dot plots from risk and reward, and there is quite a smattering of these across a broader dimension. And that's not anything wrong with the system. That is, if you take a piece of advice to a client, and you may have a completely different view, Toby, on resources compared to Will might have a more bullish call. And if there was a recommendation that came through, some clients are quite happy to say no to a recommendation that comes through from an analyst or a portfolio manager. So you do get those idiosyncrasies, and clients can often themselves bring on periods of underperformance or outperformance for that matter on any particular asset class that you might be dealing in. But more broadly, I think it's the underlying tone of a conversation. And if you're below a benchmark or above a benchmark, I think our clients have been with us long enough to know that that's, if you're shooting the lights out, that's not going to happen every period. And if you're under pressure under a period of underperformance, then again, you're not likely to continue to deliver that every quarter over time.
You started to touch on remuneration and the grid, which is a term that probably not everybody is familiar with, so you might want to explain that. But I'd like to have both of you talk a little about two things that seem to me to be related. One is who owns the clients in the JB Were and Fitzpatricks model, and how do advisors get remunerated for the work that they do?
Well, that's the $24,000 question, Toby, not the remuneration one. That's clear as clear as day. The ownership of who owns the client at the end of the day, I think it's the longest question in broking that it's never been decided really. The client relationship rests with the advisor. I have no doubt about that, and the value that exists in a client relationship sits with the advisor at the front end. If an advisor gets up to leave a firm, the firm itself, as the custodian of that relationship, will do everything in its power to make sure that client's serviced and continues to have the opportunity to continue to access everything that comes out of JB Were, whether that advisor is there in the relationship or not. So that term of who owns the client has never been tested in a court of law, to my knowledge, in my time in the marketplace. It's always been one that advisors will tell you that they own the client, and the firm will tell you quite openly that they own the client, or the client relationship rests with the firm. So I don't want to stick myself in between my advisor team and the National Bank, but thanks for opening up that gauntlet, Toby.
Well, Will, let's duck to Fitzpatricks then, and so how is the sort of what's the relationship between Fitzpatricks and the advisors and the clients in
Yeah,
your
sure.
business?
So look at most of the Fitzpatricks businesses are privately owned by the advisors, and a handful of those businesses, the parent company does have a stake in. That might have been to help fund an acquisition, but so there is a little bit of cross ownership there between the advisors and the group. So as far as your remuneration goes across the advisors, I can only speak for the Fitzpatricks Newcastle business I'm in. We're on fixed salaries, and then there's bonuses that get paid. And then as far as the engagements with the clients go, around 7 years ago, we moved all our relationships with our clients to fixed annual fees. And that reflects the complexity of the relationship with the client. So no longer fees based upon percentages we're looking after or any brokerage from that sense. It's all fixed annual fees. Obviously, we have to renew them each year with our clients and get that authority, but it's a fee that reflects the complexity of the relationship.
And that question's come up from the audience. To Andrew, how does the WEARS revenue model work with clients?
Yeah, the advice teams themselves, we've referred to it in the history of JB as the private wealth grid, and there's a scale of brokerage and the size of transactions and the level of revenue that's written, and advisors paid a percentage of that. It's all disclosed to clients in the documentation that's signed up there, and that's been in place well before I came to JB and probably hasn't changed too much in the sort of 28 years that I've been at JB either. We've had to do some CPS 511 updates to that, and that's some work we've been doing alongside with the bank, and Maria and our executive director teams have been going through that, and they announced on Friday, I think it was last week, that they've come to some conclusions on CPS 511, and we'll be looking to use the existing framework to build in the other requirements of that. But the grid has been there. I think it's a great tool to incentivize and motivate advisor and advice teams. We'd also use the same as Will has. We've got other teams that might be based on salaries, and a lot of our support staff are on a base and an STI, a short-term incentive bonus from that perspective.
Sorry, the point I was making was the relationship with the clients. Although, what? How do clients pay for the WEARS services? Obviously, you've got broking, you've got SMAs as well.
Yeah, we've got the advice. There's the advice side of the business, and there's also the discretionary piece that we talked about before. The advice, private advice side is probably the larger of those two. There's a lot of bells and whistles around the who we let use that discretionary piece, because there is advisor discretion there within the terms of an individual investment policy statement or a mandate. So we have a lot of licensee oversight monitoring that part of the business. But the advice side, there's normally a fee that's negotiated up front with the client. And I think one of your questions on the website was around, are high net worth clients more profitable? I think if you know your cost to serve and you know exactly how you get to where you are, there's no doubt that high net worth clients, given their scale, are more profitable on a per client basis than retail. But there's no saying that if you have the right solution at retail end that they're not going to be profitable as part of a business offering. That's just not the area of JB Weir that we're focusing on. So our advisors will negotiate a fee based on the size of and the scale of the client, and that fee will normally incorporate the cost of the platform. We don't charge for transactions, or there is a broking component, but our advice relationship piece, most of the custody and the advice and the transactions are all included in that all-up fee.
And so for both of you, then what I take out of this is it's effectively a process of negotiation with the clients that here are the services we're going to provide. This is what it's going to cost.
Yeah, negotiation within a framework.
Yeah. I mentioned earlier on that we're doing a study which has involved a number of interviews and discussions and a questionnaire with various participants for whom this is a a significant part of their business. One of them said to me after our conversation, "Oh well, look, I'm off to now prepare for, for a presentation to a lunch. We've got 100 of our better clients coming in. They all pay us more than $100,000 a year." And I was thinking that lunch probably had at least $10 million of revenue sitting in the room, which puts some context in that particular business. All right, look, you touched on responsible investing and ESG earlier on, Andrew, and now that we're getting towards the end of this, I'd like to come back to that issue of how issues of ESG, responsible investing, personal prejudices or incentives get adapted to in each of your organizations. How do you respond to somebody who says, "I don't care about weapons, but I'm very anti-gambling," or whatever it might be?
Yes, it comes down to the individual again, and we've built out part of that markets and investments group team of 35 odd investment professionals. We're building out a team under Gillian Gordon there. Jill runs our alts, our RI piece. Obviously, the ESG comes under that sort of category as well, as does all the privates, the private equity, private credit, private debt, those channels that we provide those access to our clients through that channel. So I think we've got more FTE, more headcount to add to that part of the market. If you look at where we are at JB Weir versus some of our competitors in that space, a lot of those have larger teams than we do, and we are still looking to recruit on that. Having a headcount freeze does make things a little bit more difficult from time to time, depending on where you are in the reporting cycle for a bank and the positive or negative jaws that exist in the environment at the time. So there are some challenges, but
look, ask the ABC for guidance. They'll tell you you do not need senior political correspondents if you can hire 2 people to put it in TikTok.
Yeah, well, there you go. But that's definitely a part of our team that we're looking to focus more on, add more resourcing to, and it is in the discretionary piece that I sort of head up the new business committee for. That is something that comes in every mandate that we get. They're sort of minimum 20 mil advisor-led discretionary mandates within a set of investment policy terms and conditions, asset class guidelines, etc. We have licensee oversight over all those, but ESG, the exclusions and exemptions, whether they be faith-based, the standard faith-based exclusions and exemptions, or even a couple that I've seen have exclusions for private prisons and quite obscure things like that are not as easy to have a systemized space.
Will, what about you? How do you manage the fact that this person doesn't like gambling and that person doesn't like live animal exports or private
sure.
prisons?
So look, thinking about my client base, where I am getting most of the ESG objectives and biases with clients is definitely in the private foundation clients I look after, and also the not-for-profits I look after, where you've got a pretty diverse board and a pretty key number of objectives around what they're looking to achieve. And often, a lot of the time, it's not just grow my money as much as you can, and it's a different framework. So that's where I'm getting the most amount of discussion and need around this space. Look, one thing I would say is Atrium Fitzpatricks, certainly Atrium, our investment house, is a much smaller investment house. A lot of our investments we do use external parties and run private mandates with institutions where we don't have the skill set in-house. ESG investing is still an area that we have got a lot of work to do in to develop our own policies and solutions around that. To date, we've been managing it via running a set of filters, especially in the direct equity space, and filtering out businesses that aren't aligned to our clients' objectives. But certainly that becomes more problematic, especially in the liquid alt space, where it is a lot harder to keep track of where the underlying exposures really sit and the boundaries of them. and also some of the global equity space, when it comes to armaments, gambling, those types of things. So look, it's certainly a work in progress, and I think we'll see a fair bit of development there in our group over the next couple of years.
Maybe we tend to put our clients in there's two categories: the do it for me clients who want us to go away and do everything as it says, do it for me, or those that want to have the do it with me, want to take the advice, hold your hand, get involved in it. And that can be anything from direct investments to managed investments, domestic equities to international, listed or unlisted. We've got those alternatives as part of our APL and high conviction list internally for advisors to tailor what the client needs and use the IP that's there to make that exposure tailored and robust.
Yeah, look, thanks very much, guys. And there've been a number of questions come in about investments. And what I would say for those of you who've asked those questions is on Wednesday, 2 days' time, we are going to be having a specific session with Martin Crabb from Shaw's and Alex Ventalon from Morgan Stanley to talk about the investment decision-making process. So I'll probably defer some of those questions, particularly about alternatives or liquids or the accommodation of client-owned assets to that session. So look, Andrew and Will, thank you very much for your time today. It's been a wide-ranging discussion, and I've really enjoyed the opportunity to understand a little more about how each of your very different organisations tackle this market. You've both demonstrated, in your case, Andrew, for over 100 years, and Will a little less time than that, but only 75 years to go. How you build a very robust, very successful business with a focus on this market. So let me just remind you of a couple of things that we have coming up on Wednesday. As I say, is we have our investment challenges webinar with Alex and Martin, and I'm looking forward to that. And then you'll have an opportunity then in Melbourne and Sydney to attend in person and talk to 6 organisations who have made this a very significant part of their business model and a very successful part of their business model. That's in association with our Advice in Action conference on the 18th of July in Melbourne, Sydney and Brisbane, the 25th. And then in September, Independent Thought with a large number of leading portfolio managers. So thank you very much for joining with us today. It's been a pleasure for us to have you all take part in today's webinar. Andrew, Will, thank you very much. Will, you can now head to bed. It's coming up to 4 a.m. in the morning there, and I'm sure bed is beckoning. I haven't seen your eyelids close once in the last 6 months.
It's just starting to get light.
Oh. Oh, you'll need to pull the pillow up over your head. So
yeah.
Thank you very much, and all the best for your upcoming wedding. Thank you very much. All right, we'll look forward to seeing you all on Wednesday.
Thanks, Toby.